Due diligence, investigation, and forensic accounting. Due diligence. What is due diligence? Due diligence is a measure of prudence activity ordinarily exercised by any prudent person. It involves careful study of financial and non-financial possibilities. It is a process of investigation into details of potential investment, such as examination of operations and management and verification of material facts. Areas of due diligence. Areas where due diligence may be undertaken are business acquisition and corporate restructuring, venture capital financing, public offerings. Difference between audit and due diligence. Audit is an independent examination and evaluation of financial statements to express an opinion, whereas due diligence refers to examination of potential investment to confirm all material facts of a prospective business opportunity. It involves a review of financial and non-financial records. Due diligence aims to take care that a reasonable person should take before entering into agreement or transaction with another party. Importance of due diligence. There are many reasons for carrying out due diligence, including to confirm that a business is what it appears to be, to identify deal killer defects in target company and avoid bad transaction, to gain information that will be useful for valuing assets and negotiating price, to verify that transaction complies with investment or acquisition criteria. Classification of due diligence. Due diligence can be classified into following categories. Hint is CPT file. C. Commercial or operational due diligence. P. Personal due diligence. T. Tax due diligence. F. Financial due diligence. I. Information system due diligence. L. Legal due diligence. E. Environmental due diligence. Next, process or scope of financial due diligence. It is a full-fledged financial due diligence is conducted. If a full-fledged financial due diligence is conducted, it would include following matters in its scope. First one, history of target company and promoter's background. Accountant should begin financial due diligence review by looking into history of company and background of promoters. Accounting policies. Accountant should study accounting policies being followed by target company and ascertain whether any accounting policy is inappropriate. Review of financial statements. Accountant should examine whether financial statements of a target company is prepared as per statute governing target company and relevant accounting standards. Taxation. Check whether company is regular in paying various taxes to government. Cash flow. Review of historical cash flows reflect cash generating abilities of target company. It is necessary to check that is company able to honor its commitments to trade payables, banks, government and other stakeholders. How well is company able to turn its trade receivables and inventory? How well does it deploy its funds? Are there any funds lying idle? What is investment pattern of the company? And are they easily realizable? Next, financial projection. Accountant should obtain projections for next 5 years from target company with detailed assumptions and workings. Management and employees. It is important to check that all employee benefits like PF, ESI, gratuity, and superannuation have been properly paid. Statutory compliance. It is important to make a list of applicable laws and checklist of compliance. Next, hidden liabilities and overvalued assets. Object of due diligence will look specifically for any hidden liabilities or overvalued assets. Hidden liabilities. Company may not show any show cause notices as contingent liabilities, tax liabilities under direct and indirect taxes, long pending sales tax assessments, pending final assessments of customs duty, agreement to buy back shares, future lease liabilities, environmental claims, environmental claims, huge labor claims under negotiation. This all comes under hidden liabilities. Next, overvalued assets. Overvalued assets like uncollectible receivables, obsolete non-moving inventories. Are inventories valued above NRV? Underused or obsolete plant and machinery and their spares, litigated assets and property, investments carried at cost, through realizable value is much lower, though realizable value is much lower, infructuous project expenditure or deferred revenue expenditure, group company balances not reconciled, intangible assets of no value. This all comes under overvalued assets. Contents of due diligence report. Example of headings of due diligence report. Executive summary, introduction, background of target company, brief history of the company, objective of due diligence, shareholding pattern, SWOT analysis, assessment of management structure, valuation of assets, operating results, financial liabilities, taxation liabilities, litigation liabilities, and net worth, comments on future projections. Work approach to due diligence. The purchase of business, in many instances, is the largest and most expensive assets purchased in the lifetime, and therefore, some caution should be exercised through the due diligence process. Therefore, assessing the business's fair value passes through reviewing and reporting on financials submitted by the target company, assessing the business firsthand by a site visit, if applicable, working through the due diligence process with the acquisition company or investor by defining the key areas, helping prepare an offer based on completion of due diligence. Discovering the correct strategy is always challenging, and even more so during challenging economic circumstances. Each situation is unique. The variables are numerous, including factors such as company age, markets, geography, price levels, competitive dynamics, to name but a few. But when a company and its products are turned to match market needs and expectations, that is, the decision makers and the influencers involved in purchase decision, exceptional changes in performance can occur. However, comprehensive model that describes this approach to the work is illustrated in the figure below. First, define, next, diagnose, deliver, design, discover, defend. Next, how to conduct due diligence. Start with an open mind. Do not assume that anything wrong will be found and look for it. What needs to be done is to identify trouble spots and ask for explanations. Get the best team of the people. If you do not have a group of people inside your firm that can do the task, example, lack of staff, lack of people who know the new business because you are acquiring a business in an unrelated area, etc. There are due diligence experts that you can hire. While hiring such professionals, look for their experience record in the industry. Get help in all areas like finance, tax accounting, tax accounting, legal, marketing, technology, and relevant any other areas relevant to the assignment, so that they get a 360-degree view of the acquisition candidate. Talk to customers, suppliers, business partners, and employees are great resources. Take a risk management approach. So while you want to do your research, you also want to make sure that you do not antagonize the team of people of the target company by bogging them down with loads of questions. Prepare a comprehensive report detailing the compliance and substantive risks or issues.